guys, did you recap what Maxon said about audit planning?
I only remembered the pre-plan of client acceptance. Let me explain to you guys what is pre-plan and client acceptance. Pre-plan stage involves decision to accept new appointment or to continue in office. Decide whether to accept or continue doing the audit, to investigate new clients, and to evaluate existing clients. Identify clients' reasons for the audit, financial audit, or special audit, example, loan application, acquisition of business, takeover, and managers. Know the factors that should be considered by an auditor before accepting appointment from a new client.
Okay, as I know, the factor is the management integrity, ability to perform the audit work, and issue an engagement letter.
Now I remember what Maxon said, everything last week.
Oh, it almost 7. I think we better go.
Okay, yeah, true. Let's go guys.
Okay guys, today we're going to learn scope of audit. We will start with engagement letter. Audit will point out that the audit will plan so as to have a reasonable assurance of detecting material misstatement in the financial statements resulting from fraud. The auditor will stress that it is the responsibility of the audit client to detect and prevent fraud. Okay, this is the purpose of issuing engagement letter, to avoid any misunderstanding between a client and an auditor, and to have evidence of acceptance. And I will go to the content of an engagement letter. Identification of the statements that are subject to formal examination, and it also has the objective of the audit of financial statement, the scope of audit of financial statement, the management responsibility for financial statement, the degree of audit assurance, to the form of audit report, letter of representation, audit's right to access records, document and information, deadlines for completing the audit, audit fee, and finally acknowledgement of acceptance of the term by the client. Now we will move to fraud and error. Does any of you know what it means?
Let me answer. Errors are caused unintentionally. For example, arithmetical, data entry, programming and clerical mistakes, oversight or misinterpretation of facts. While fraud is an intentional, fraudulent act by those charged with governance in an organization.
Last, scope of audit is objective. Now, audit objective. The objective of audit, the financial statement as stated in the International Standard on Auditing, is to enable the auditor to express an opinion whether the financial statements are prepared in all material respect in accordance with identified financial reporting framework. The two types of audit objective is transaction related to audit objective, balance related audit objective. Okay, Isabel, can you tell me about assertion?
Now I will tell you 7 categories of assertions. One is existence of occurrence. The existence assertions deals with whether assets, liabilities, and shareholders' equities, including the SOFP, actually existed on the SOFP date. Next is completeness. The assertion stated that all transactions should have been recorded were actually recorded to the general ledger, and all accounts are included in the financial statement. Next is rights and obligations. It deals with whether assets are the rights of the company, and liabilities are the obligations of the company at the SOFP date. The next one is valuation or allocation. Valuation assertion deals with whether assets and liabilities are regarded in the appropriate carrying value. The fifth one is the measurements. It deals with whether a transaction or event is recorded at the proper amount and revenue and expense are allocated to the proper period. Example, like the property is recorded at the historical cost and the cost is systematically allocated to appropriate accounting periods through depreciation. And last but not least is presentation and disclosure. It deals with whether components of the financial statements are properly classified, described and disclosed with acceptable accounting policy when applicable follow the requirements of the Company Act 1965.
Good, Isabel. What about transaction-related objective?
I will explain the transaction-related audit objective. The first one is existence. This objective deals with whether recorded transactions have actually occurred. Inclusion of a sale in the sales journals when no sales occurred violates the existence objective. The second one is completeness. This objective deals with whether all transactions that should be included in the journals have actually been included. Failure to include a sale in the sales journal and general ledger when a sale occurred violate completeness objective. The third one is accuracy. This objective deals with the accuracy of information for accounting transaction. For sales transaction, there would be a violation of the accuracy objective if the quantity of goods shipped was different from the quantity billed. The wrong selling price was used for billing.
Okay, lastly, Chibi, explain general balance and related audit objective.
Okay, there are 9 general balance related audit objective, but I can explain 3, which is existence. This objective deals with whether the amount included in the financial statement should actually be included. For example, inclusion of an account receivable from a customer in account receivable trial balance when there is no receivable from a customer violates the existing objective. Okay, 2, completeness. This objective deals with whether all amounts that should be included have actually been included. Failure to include an account receivable from a customer in the account receivable trial balance when a receivable exists violate this objective. And 3, accuracy. The objective refers to amount being included and at the correct arithmetic amount. An inventory item on a client's inventory list would be wrong because the number of units of inventory on hand was missed. The unit price was wrong.
Last week I gave you guys some subtopic on presentation of audit planning. Did you guys do it?
Yes, we did. So I'll show the video presentation after this.
Knowledge of client's business and industry. Number 1 is the nature of the client's business. Number 2 is the level of competition within that industry. The third one is the client's customers and suppliers. Under entity level, major customers and major suppliers are being assessed, so that the auditor may consider whether those customers have good reputation, are on good terms with the client and are likely to pay the client on timely basis. This is an assessment is made of client's debt sources, the reliability of future of source of financing, the structure of debt. Level of competition to consider client's reputation relative to other companies in the same industry. An auditor assesses how economy-level factors affect client. Economic upturns and downturns, changes in interest rates, and currency fluctuations affect all companies.
Client business risk. The critical issues facing the industry. Clients plan for market share and profitability. Clients' measurement of performance. And lastly, clients' threats and competitors.
Next is analytical procedures. One of the analytical procedures is preliminary analytical, performed to obtain an understanding of the business and its environment. It is also to help assess the risk of material misstatement in order to plan nature, timing, and extent of audit. For example, to help the auditor develop the audit strategy and program.
Materiality. Definition. Materiality is an auditor's preliminary estimate of the smallest amount of misstatement that could be material to the client financial statement. Concepts of materiality. Materiality is the criteria used by accountants and auditors in distinguishing between unimportant and important matters. Auditor is responsible to determine that the financial statements prepared by the management are free from material misstatement. If material misstatement exists, the auditor should bring the matter to the client attention to take action to rectify such misstatements in order to give a true and fair view opinion on the financial statement. Types of materiality. Qualitative, total assets, total revenues, net income before tax, gross profit. Quantitative, non-compliance with laws, small amounts that might violate convents in a contract, and amounts that affect in earnings.